Imagine handing someone $50 million knowing that there's a 95% chance that they will fail. That's exactly what LPs face every day when investing into VC funds. And as a GP, this puts you under constant pressure. One mistake can seriously damage your reputation. In this video, I'll clearly explain how LPs decide who to fund, the exact checklist they use to evaluate you, and the behind-the-scenes steps they take before investing. Most importantly, you'll learn how to speed up the fundraising process and how to build trust with your LPs. When an LP meets you, they first look at your track record. They don't care about flashy numbers on paper. They want proof that you have actually returned money to investors. Real cash returns matter more than theoretical gains. If you can show that you have successfully exited companies and doubled the investors' money, you will immediately stand out. Next, LPs carefully examine your investment thesis. You must clearly explain what you invest in, why your approach works better than others, and how your specialized knowledge adds value. But having a strong thesis isn't enough. You need the right team to execute it. LPs closely assess your GP team's track record, looking for evidence that you have consistently picked winning companies and successfully navigated difficult situations. Highlight concrete examples, such as team members who have built or exited successful startups. If you want to move faster in your fundraising journey, it's crucial to build a solid investor pipeline end-to-end. And at spectup, we do exactly that. Click the link in the description and let's talk. Once LPs feel confident in your team, they dig into your fund's structure and ownership strategy. Large funds with small stakes in many companies don't generate a significant return. On the other hand, smaller funds that own bigger stakes in fewer high-growth companies, like owning 10% of a rapidly growing software-as-a-service startup, can deliver impressive results. LPs look closely to make sure your investment strategy matches your fund size. And when the basics look good, LPs start thinking about co-investment opportunities. LPs want to see that you have invested your own money into the fund. This shows them that you are super committed and willing to share both the rewards and the risks. But LPs won't just trust numbers or presentations. They'll directly talk to people who have worked closely with you, including founders, co-investors, and past colleagues. Positive feedback on how you deliver real value, keep promises, and support your companies makes the fundraising process moves faster. Negative feedback can immediately stop the process. Also, every LP has unique priorities. Some focus heavily on your team experience. Others care more about geographical regions, specific sectors, or impact-driven investments. Addressing these individual preferences during your meeting with the investor makes a real difference. For example, if an LP cares deeply about social impact, highlight specific ways your companies create measurable social or environmental results. Now let's quickly look behind the scenes at how LPs carry out due diligence. It all starts with relationship building, which usually takes a year or more. Once interested, they dig deeply into your financial details, reviewing metrics like DPI, TVPI, and ERR, as well as examining cap tables, valuation strategies, and your reserves. If your numbers look good, they then directly speak with your references. They call founders, co-investors, or former colleagues and ask straightforward questions. Do they keep promises? Would you invest again in them? Negative responses here can severely impact your chances. Positive references lead LPs to benchmark your fund to similar ones. They compare your strategy and results to peers, so you will need to clearly show why you are uniquely positioned. All this information finally goes to the LP's investment committee, where they decide, evaluate risks, and decide whether and how much to invest. Let's look at what happens after the paperwork is signed. First, Keep the conversations alive. One quick relaxed webinars where you explain what's happening in the market and why you are making certain bets. Share short, real-world stories. Case studies that show how one of your portfolio companies grew because of a choice you made. And send a brief monthly note that covers the wins, the stumbles, and the lessons learned from each. Next, give LPs a window into the fund. A simple dashboard. Open it, see the key numbers, close it, beats a 40-page PDF every time. For extra peace of mind, invite an outside firm to audit your processes. An independent seal of approval lowers the what-if worries. Most important, keep listening. Ask for feedback, answer questions fast, and let LPs know their ideas matter. Fundraising isn't a one-off event. It's an ongoing relationship built on openness, steady updates, and results you can prove. Do that well and you won't be just another pitch deck in the pile. You will be the partner LPs are eager to back. If this helped, hit the subscribe button below. Maybe leave a comment if you want. I would love to hear what you think about this video and maybe also my other videos. And yeah, if you have any ideas, suggestions, feedback for more videos or topics, let me know. Would love to hear your feedback. Goodbye.